Welcome to Kitco News. I'm Niels Christensen. So in the first quarter, we saw bullion banks take million-dollar losses because of the gold price, which was impacted by supply chain issues related to COVID-19 pandemic. We're still seeing residual effects of those liquidity issues. Here to talk about the problems and how those are affecting prices is Ole Hansen, Head of Commodities Strategy at Saxo Bank. Thank you very much for joining us today, Ole.
Thank you, Niels. Thank you for having me.
It's nice to talk to you again, and we've actually been talking about this issue on and off for a while. How big of a problem is it when market makers are shy to dip their toes back into the gold market?
Well, it is important because outside of Asia and outside of China, the two major sources of liquidity is really in London, where we trade the spot market, and then in the futures contract traded on the CME exchange in the US. And up until that pandemic broke out, we had obviously a normal supply chain, supply route between the two markets, meaning that if you had an exposure in the spot market, you could hedge yourself in the futures market, and if you wanted to, you could take delivery or you can make delivery. That whole transatlantic chain basically broke in March when transportation flights were grounded, refinery activity in Switzerland was halted, and we saw that blowout in the spread. And I think we're still suffering the consequence. I think and it's also raised some of the recent comments that gold is not as interesting as it has been because we're seeing low activity in the gold future. But I think we just have to look at gold futures and ETF positions combined. No doubt that open interest right now has come down to a 1-year low in gold futures, and we're also seeing speculators. Even though we have this still, I'll say, elevated price and prospect of moving higher, we've seen speculators cut their net long to a 1-year low as well.
So, what do you think? Do you think it's just a matter of time before market makers come back, before liquidity normalizes, or should we be paying more attention to gold as an ETF more than a futures commodity?
Well, I'm torn on that one because I tend to watch the spot market the most because then obviously I don't have any rollover discrepancy on the chart and so on. But at the end of the day, the liquidity has been and probably for now will continue to be primarily in the futures market. But there is a risk that some of these market makers, having taken a massive beating, some have left the market, some have had their limits cut down, and that basically means they don't have the same risk appetite anymore. And on that basis, I think that's also one of the reasons we may have seen some of the longer term investments who have been held through the futures market may have been transferred to the ETF market, and I think it partly explains why we have now exceeded 100 million ounces according to data.
Let's look at the resilience in this marketplace. I mean, we did see gold drop below $1,700 briefly. It's back up. You noted in a report that the correction is only, gold is only corrected 5% from its highs. What are your thoughts on this underlying strength that's supporting this market?
Well, I think as long as we got everyone from a professional to a retail investor still piling into equities, there's not really we've seen some of that having a diminishing impact on the short-term demand, at least for gold, because obviously the rally we're seeing in global stocks right now is being interpreted as a V-shaped recovery, and while we all talk about the complete dislocation between facts and figures, with the fundamentals not really stacking up to support the rally we've seen in stocks, it's nevertheless a key indicator or key driver for the market. So as long as we continue to see that move, and now we've got Nasdaq within a whisker of the record highs, S&P is not far behind, we're probably going to see these markets either stabilize or potentially move lower. And the question is really, when will that happen? Well, I think at this stage we're entering into the summer months now. We're going to see continued lockdowns being eased, and the risk from a gold perspective is that some of the risk appetite in the market will stay firm, probably until we start to see some of these company earnings into the second quarter.
It's hard to look at equity markets when, like today we saw unemployment claims, surpass initial jobless claims surpass 40 million claims. It's hard to see equity markets up 40% from the lows, this record rally, it feels like we've really learned nothing from 2 months ago when, people were saying that, hey, we're already late into this business cycle and we need to sort of, slow down a little bit.
Well, someone jokingly said recently that we need to get all the sports activities back because we had a lot of sports bettors coming into the stock market because obviously there's nothing going on in the world of sports right now, and these guys they're playing it from the long side only, and even though they are small in size, when they accumulate to thousands, potentially even millions of new accounts trading stock markets, then we do get this dislocation because they don't look further out than the next trade and the next day. So fundamentally, we need to see some of the correction coming in, and it's also interesting to see that the non-commercial short in the S&P is I think is close to a record high. So basically, the market is short while the market is going up, and that does indicate that we probably have a bit of a battle going on between your retail investors of this world, and then probably more institutions who are either long some tech stocks and short the S&P against it. But overall, clearly we are looking for this to fade sooner or later.
Mm-hmm. Let's look at some fundamental news. Today, Thursday, we saw the ECB increase its emergency pandemic spending program by 600 billion euros. I think. What are your thoughts? I mean, this just seems like it underscores the massive money printing that we're seeing that's going to support gold prices long term.
Well, I think the idea is that if you have a small problem, you borrow a small amount of money. If you have a huge problem, you borrow a massive amount of money. The only thing that's happening is we're piling on debts, and it really is. It will eventually, over time, be unsustainable. Just look at Germany. They just announced another package last night. All the stimulus now accounts for more than 30% of German GDP. This is a country who has been very stringent in terms of balancing their books for decades, and suddenly they're going all in. This is telling me that they have massive economic problems, and we've got that everywhere around the world. And it's being and the hope that increasing stimulus and increasing debt can save the man in the street and get his job back, I think is probably wishful thinking at this stage. So I'm a little bit sitting slightly sitting away from the market, just watching what's going on unfolding right now, and not really wanting to get involved on at least in the equity markets. And I see the reason for gold stronger than ever, because as a diversifier and as a hedge, but also clearly have to accept the way the market behaves right now, that we need to see a potential trigger. And so far, with all the things all the tailwind that gold has had now for the past couple of weeks, we had a weaker dollar, we had the unrest in the US, we got increased China-US tension. That is obviously something that you have to accept and then say, well, this potentially not is the time just yet. But patient as when it comes to gold, it is a frustrating metal from time to time, but it's also one where you quite often have to have quite a bit of patience.
Thank you very much for your time, Ole.
Thank you.
Thank you for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.